Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it's July the 27th, 2015. Now, I want to take a few moments today just to talk a little bit about what we see happening in the marketplace, and also just to highlight what most of you are probably aware, and that is July has been a tumultuous month when it comes to volatility and the ups and downs in stocks, the change in prices in commodities, oil, gas, gold, silver, interest rate moves, the Greek crisis, and so on and so on. And so we want to bring it back to fundamentals again and what we see in the marketplace and where some of the opportunities are. In order to do that, I'm going to make reference to 3 slides that we're going to hold up, and I just want to make some quick comments about these 3 slides. The first one is the commodity index. Now, this is a basket of commodities, everything from precious metals to oil and gas to agricultural commodities to base metals and so on. But the point here is that the commodity index, when you weight it and you value it, is back to 2002 levels. And so we've seen commodities come up a great deal, go down a little bit during the financial crisis, come back up again, and then all the way back down to 2002 levels. What is this telling us? Well, it's telling us a couple of things. First of all, that the global economy is very weak. There is not a lot of economic growth throughout the global economy, number one. Number two, it's telling us that inflation and price, putting the prices up and price pressures, if you will, are going to be fairly muted, particularly in those economies that price pretty close to the US dollar, because commodities are priced in US dollar. It also tells us that the Canadian dollar, which we are obviously very concerned about, will probably remain fairly weak because much of our economy is dependent on exporting of commodities. It's a resource economy underneath it. And so this is an important chart, and it gives us very important information. It means, look, things are slow, the global economy is weak, and that also then filters nicely and transitions us nicely into the second slide, which is one on interest rates. And in this slide, I just want to highlight the interest rates, the long-term treasury rate. That's the 30-year bond in the United States. And you can see that back in 1990, that was trading around 9% yield. Currently, it's under 3%. And our view is, yes, rates will eventually go up, and yes, the Federal Reserve and the central banks have been trying to keep these rates lower. But given the weak commodity pricing, given the weak global growth, given the weakness we see everywhere around the world, it's doubtful that on their own interest rates are going to jump up quickly anytime soon. And so this also means that we can not expect a lot of increase in rates. It means that some of our investments that are priced off of dividends and pay yields should remain pretty solid investments as investors continue to look for yield and return. The third slide that I just want to highlight quickly is a slide that details industrial production in the United States. And you can see that this slide shows that industrial production, having taken a precipitous fall back in 2008, 2009, in the middle of the financial crisis, did bounce back, but has now gone negative. This tells us that in the United States, which is supposed to be one of the strongest economies, if you will, right now, is weakened, and it is not growing very quickly also. So all of this points in one direction, that there's very little economic growth. It's going to be tough for companies to grow their earnings really quickly, that the markets are going to continue to probably be quite volatile as they search for direction and try to figure out exactly what is happening in terms of the market. What does that mean for us? It means that we continue to invest in very strong companies, in many cases global companies in certain segments that have above average growth. It means we should keep some cash around because this volatility is going to give us some great entry points and opportunities to buy great companies at cheaper prices. And it also means, in terms of one segment in particular, the precious metals, that we see some wonderful opportunities if we're careful and we just dollar cost average into the royalty and the streaming companies. Now, we talked a little bit about this in our last quarterly report, and as we've discussed many times, the world is a very slow growth place. The central banks will continue to be aggressive, and this means more money printing, lower rates, and it means ultimately currency debasement is going to be essential if they're going to deal with the debt problem. This will eventually translate into much higher gold and silver prices. We're not predicting when that's going to happen, but if we can buy businesses that are exposed to the gold and silver sector, and we can buy them at incredibly low prices, really cheap prices, companies that are growing and generating good cash flow today, then those returns will be astounding going forward. And that's exactly what we're doing. We continue to pick off shares in Franco-Nevada, Royal Gold, Silver Wheaton, and Sandstorm. We know that they are volatile, but we also know that they are some of the best positioned businesses that we can possibly find in this market, given all of the challenges around the world and the ongoing aggressive monetary policies that we see everywhere, and they are not going to go away anytime soon. I recall just a couple of weeks ago a visit from a tremendous investor into my office back in 2000, and that was Mr. Seymour Schulich. He came into my office. At the time, I was in a company, Georgian Capital, that I had founded in Mississauga. And he came in to tell us about his great story, Franco-Nevada, that they were going to be selling at that time to another business, and he wanted to get our support because we were large shareholders. And I'll never forget him telling me as he looked at me, he said, "Jonathan, you know, this business is an amazing company, but I have no interest. No one is interested in what we're doing. All they're interested in is the next new thing." And that was right at the time when the technology industry was reaching its peak. Well, we know what happened. The technology industry vaporized, lost 60–70% of its value, and a lot of the top gold and mining companies like Franco-Nevada have gone on to double and triple and quadruple in value. And so you can really get major disconnects in the marketplace, and we're seeing some of that today. And our ambition is to stay focused on the businesses, look at the solid, rocks that we can invest in terms of businesses with wonderful franchises, wonderful cash flow machines, and take advantage of the extreme pricing that we see right now, especially in the precious metal sector through the financiers. So that's what we're looking at in July. We're trying to take advantage of the volatility. We welcome the volatility, and even though it might bounce around some of the numbers in your portfolio, we love the companies that we own. They are doing well and just becoming stronger and stronger in terms of the underlying business. Many years ago, I think it was Warren Buffett said that you keep your eyes on the playing field, not the scoreboard, because if you keep your eyes on the playing field, eventually the scoreboard will reflect very well on your team and you will win the game. If you have any questions, please let us know. Stop by, email, call anytime, and trust your summer is going well and you continue to enjoy the great weather. Thank you very much. Bye now.